Ladies and gentlemen, welcome to episode 9 of Investing with the Boys. We discovered a new hobby last week, which was losing money, and we followed it up this week again, even more skilled, losing money. Logical, tell us what your strategy was this past week and how you fared with the bloody market.
Yeah, it wasn't pretty for me either. Realistically, I continue to give back a lot of gains. I'm blessed to still be positive P&L year to date, but I've been fighting tooth and nail for it. So, and I think what's really important to remember is like people are concerned that they're slightly red or whatever they are. They might be more than slightly red, but all that matters is your performance relative to the S&P 500 and on the longer term basis. And I know, Sam, you had a post recently that was basically like, you gotta, when you're gonna really outperform on the upside, I mean, you might underperform on the downside, but as long as over time you're outperforming, that's really all that matters. But yeah, I mean, I'm getting, single digit green, but much better than single digits red on the S&P this year. So I'm happy about that. What I would say is we're getting to a point where this is the fastest 10% correction, one of the fastest in history, and it's just been straight down, no bounces. It's a little concerning, but I'm actually feeling pretty good. My base case is not a recession. If it was, then I think maybe we'd be in for a lot more pain. But looking at where we are today versus something like a 2021, 2021, we were full on bubble, 0% interest rate. Everyone was raising cash, taking pre-revenue companies public. I don't think we're there. I mean, we definitely had some bubbly stocks. But you look forward, and we actually have the ability to reduce interest rates which will be more favorable for valuations. Back then, we had 0% interest rates, and we were going into a period of the fastest rate hike cycle in history, basically. So just the economy was, they slammed on the brakes. And so I don't think we're there right now. And while we're having potentially a slowing economy, I don't think it's the end of the world. It's probably a good thing, but they keep saying they're gonna do all this government efficiency stuff, but we just got the February fiscal deficit spending numbers, and they're just surging. So watch what they do, not what they say. It's possible that we look back on these days and stocks overcorrected to the downside, because I mean, while the S&P is just down maybe 6% on the year so far, many stocks are down 20, 30, 40, 50%. So we'll have to see. I would say right now is not the time to be selling things or shorting things. I think that's gone a little bit too far, and we're definitely due for a bounce at some point. I think what's really important is to start putting our investor hats on and feeling very comfortable with what we are long in this market. You need to look at the fundamental thesis of what you own and feel comfortable and confident in that. So be able to justify the valuations that you're paying for equities. And for me, I'm greater than 100% long right now. I'm on margin. I mean, I've been buying things that I really want to own, and we'll get into one of them later today that I finally decided to stick with. But yeah, I mean, I think this is the time to really look for those deals in the market. A lot of stocks have overcorrected. And one thing that I want to shout out is looking for relative strength and what's been holding up in this market. Obviously, we've talked a lot about ex-US. Like China continues to be a really good performer. I would say Latin America, a couple of the stocks that we talk about, Columbia Bank and stuff like that, have been really good. But pause on that. Biotech. Today, we saw SPY put in a new lower low. We saw IWM put in a new lower low. XBI, no new lower low. So I love to see that. The stocks that I'm long, every time they get kind of down to a certain place, it's like a bid just comes in automatically and buys up those stocks. While I'm feeling like anxious that, some of my stocks are definitely pulling back, and I'm at a point where 50% of my portfolio is allocated to biotech at this point. I obviously get a little antsy, but the value is there, and this is a sector that's been basically depressed. No flows to it. Valuations are extremely cheap. You're seeing most of these stocks trading at like near their cash on the balance sheet. I mean, near negative enterprise values. Huge upsides basically being priced at $0. Focus on value in this market. That's what I can say. And I would say that there is a good amount of value, but I'm personally, knowing that we're headed to a potential consumer slowdown, I want to distance myself a little bit from the US consumer exposure. Most of my portfolio is no longer in that. Funny enough, the stock I'd like to talk about later today is US consumer exposed, but I think valuation comes into play there. And yeah, so yeah, one last thing I want to say is I think, when we had the DeepSeek moment and a lot of stocks got oversold, people just assume, hey, we're going to buy this dip immediately. But a lot of those stocks, after they bounce, have actually continued lower than the DeepSeek levels. We just got to really be, think that maybe, these stocks that were the leaders might not be the leaders coming out of this correction. There's really been a character change in this market. So just be really careful and understand that what went down a lot doesn't necessarily mean that it's a buy just because it's down 50% from, you could argue, bubbly valuations. It should have never been that high. So just because something's down 50% doesn't mean it has to go right back and correct. And I mean, yeah, we were pretty overvalued. So just keep an eye on that, and especially the names that have consumer exposure. We talk about, big tech has a CapEx cycle this year, and so it's going to be really tough for those stocks to get going and lead coming out of this as well this year. So just keep an open mind for what's going to be the new leaders in this market. I'll pass it to Sam.
Yeah, I mean, totally agree with you on that end. DeepSeek, there's a lot of names I can think of off the top of my head, like AMD for one, just keeps going down. It hasn't really recovered since DeepSeek. And, nothing against AMD. In fact, I haven't even done so much research in AMD, mostly because I'm not really looking to get into semiconductor play right now, especially when it comes to providing compute for computers. But yeah, that's actually a name where I think about that. And I also think of Microsoft, Google, especially Google. And other than a narrative when it comes to Google, in fact, I think unless people are selling because they're fearful that Google isn't going to have that premium that it could be having. In fact, I don't think it has a premium at all. It raised at a pretty reasonable valuation. In fact, probably undervalued, determining its free cash flow margins, how much it's basically printing every single year. But I do think that a lot of valuations have gotten pretty compressed to the point where now it's, I don't want to say unreasonable, because at the end of the day, a lot of what I invest in is software, and software is notoriously known for being expensive. Regardless, you're never really going to find a software stock that's undervalued, mostly because most of the time, almost all the time, software stocks are priced in based on their future forward-looking estimates, in addition to their annual recurring revenue, which is the reason why they get a premium, is because you're able to see on paper what or how much a company or how much a group of companies are paying in terms of annual contractual value or annual recurring revenue. It's very predictable. So when it comes to that aspect, these software companies have pulled back considerably. They're certainly not cheap when you compare them to a value stock out there like Google, but at the same time, it has a pretty good setup going forward. At the same time, bottom calling in this market, man, I probably call the bottom maybe 5% up from here. So clearly I'm not the best person when it comes to that. But at the same time, I'm not trading my portfolio as if I am calling the bottom right now. However, cash is becoming very thin. A lot of people, almost everyone besides Shai, has ran out of cash if they are buying for the long term. In fact, I think Shai is one of the only few long-term portfolio investors that is holding almost everyone's portfolio in cash right now. I'm just kidding around, but I'm consistently buying every single week. So I'm not I have zero cash left. I'm adding cash every single week into my portfolio, and I'm going to continue buying. That's just my motto, because I see something that's a good valuation, I'm going to take it. And yes, there's definitely a lot better deals than they were a couple of weeks ago. But at the same time, something to keep mindful of is that I've been listening to a lot of software earning calls and reading a lot of reports, and kind of reading between the lines here, there is definitely a contraction in IT spend, and it is hitting everything across the board. It is also the case for certain companies more than less, specifically SentinelOne, and you're not really hearing the same thing for other companies as much to that degree, like CrowdStrike or Palo Alto. But at the same time, it is mindful that you're hearing a general theme across the board that there is a contraction in spend, and that for some people, they might say it's a new normal, which I disagree with. I don't think it's a new normal. I just think that it's companies and CEOs and CFOs that are preparing for what the data is showing, and data is showing that there is a slowdown coming. So you can't discount that. My base case also is that there's not going to be a recession, because we've been in this scare and fear all the time, which constitutes a 10% drawdown. But at the same time, it could happen. I'm not going to be sitting here and be like, it's not going to happen, because it can happen. And the market's down 10% correction right now, but we could be in a bear market. I'm not going to say it's not going to happen, because it can happen. I don't care what you say in 2021. And I know you say it too, that we are ridiculous valuations, but hindsight bias means a lot, okay? Unless you went cash in 2021, there was no way you would have known we would have went in a whole year-long bear market. No one would have known that. And that's the reason we bounced so hard. I'm not saying we're going to bounce so hard after this. What I'm saying is that no one has any idea where this market's going to go. For me personally, I trade a good portion of my portfolio, nearly 20%, in a lot of short-term and medium-term swings. And most of that I've just been attributing toward the long term and doing a lot less trading now because of the fact that, dude, I remember when we started pulling back around 3 to 4%, I was trying to call the bottoms of like very small positions of short-term calls. I know I said I'm not really trading the short-term in size, but very small, like $100 or something, right? And I've been quick to take profit and lucky to get out of it alive, right? So I'm not doing that right now because that wastes too much energy right now. The market is so volatile. Even this morning, everyone thought we were going to bounce. And then we had the spaces on Twitter, and then before you know it, the whole thing like collapsed and we closed at low of days. Like that is the most bearish sign you could possibly see. Closing on the low of days, especially a 52-week low, not a 52-week low, but especially the most local low, right? A lower low. I am not trying to buy that dip with short-term calls, hoping that I'm going to catch the bottom because I could be wrong 10 times before I'm right. And by the time I'm right, I'm insolvent. So I'm not going to do that. If I'm going to take a little bit of stabs with money that isn't really a big deal to me, like 0.01% of my portfolio, then so be it. But at the same time, I'm not going to try to call the bottom of this. Like, in fact, I would say that probably 2 or 3% ago, almost everyone on Twitter, which is still to this day, is expecting some sort of bear market or expecting some sort of continued pressure to the downside, which could happen. But if you ask me, everyone was on one side of the bull train coming into the end of last year. Now, I really feel like everyone's on the bear train right now. And I feel like people have just given up and trying to call the bottom at this point. And when that happens, that causes a lot of short covering with any catalyst. We haven't had the catalyst to the point. CPI was not cool yesterday. It wasn't hot, which is perfect. It was Little Red Riding Hood. It was just right. I'm sorry, that's not Little Red Riding Hood. That's Goldilocks. It was just right. PPI came in a little bit weak from month over month, but that's because of the front loading. We'll see what happens next week when more economic data comes out. But you look at the stock market, look at economic data, it's not looking good, right? It's not going to be like, oh, we're going to bounce back to all-time highs. Like, if we do bounce, I don't know if we're going to go to all-time highs or not. I'm going to play it by ear, right? So we'll see. I don't want to talk your ear off, but yeah, I mean, what do you think, Shai? How are you doing?
Well, that's the whole point of the podcast.
Money. Yeah.
You're supposed to be talking people's ears.
I'm not the whole time, man. Come on.
No, I mean, so I think we're, like Sam alluded to, I do have a cash position. I have a 10% cash position. I was hedging beginning of the year, not because I predicted a 13, 14% pullback. It was just hedging was cheap and the VIX had a 14 handle. Like, I had a very simple formula. Like, I hit you guys up on the group chat. Every time I hit a 14 handle, I bought some puts for June, September expiry. Every time I hit a 20 handle, I sold them. And then when things got really bad after SPY and QQQ broke through or not SPY as much, but QQQ broke through the 200-day moving average, I was like, I think this is going to get worse because we're not like bouncing off that or having any resistance. It's just clean cut. I bought some SQQQ. You guys should not be able to, don't use these triple leverage tools unless you're experienced in doing so. Heavy leakage long term. You can really lose your money, but I thought things would get bloody. So right now I have no hedges on. I do think there is going to be somewhat of a bounce because I know a lot of people don't love RSI. They don't put that much weight behind it. I kind of do on short-term moves. Right now, the daily RSI on QQQ is at 25. Anything below 30 is oversold. So I think there's going to be somewhat of a short-term balance, and we keep trying to do it, have one, and it's just getting faded aggressively. Like, it just feels ugly out there. And I do think that although the RSI is oversold right now, we might bounce. The same thing the last time we were this oversold was January 2022, 3 years ago. And when that occurred, QQQ went from 335 ounce to 365, and we know what happened the rest of the year. It was just a short-term lower high, new lows, and just it was ugly from there. So I think that I don't think it's gonna be like a 2022 bear market. I think Logical is one who actually sets on the spaces where it's similar to 2018. I do believe it's a short-term bear market. I think a lot of the commentary you're getting from Trump's cabinets, the Fed, everyone, like honestly, everyone who's just on a microphone at a big stage is just saying short-term pain for the long-term gain. I don't think recession is my base case. However, I do want to call out like I got a lot of questions as well where people are like, oh, we got a great CPI and PPI print. Like, why aren't we green? Like, why? Like, this will have caused the market to fly before. it's because it's really important to know why we're selling off. This isn't an inflation driven sell off. Like that's the biggest disconnect on CPI and PPI and why the market's pulling back. Like the real issue has been the excessive tariffs, the impossible environment that we're kind of in regarding the policy shifts, how unpredictable they are, and then also the erratic messaging of those policy shifts. It's snip, snap, snip, snap. Like you say something, hours later, something else happens. They one up each other. Like it's an impossible environment to be in. So as an enterprise, as an investor, even as a market, like they all hate uncertainty. And right now, there is a boatload of uncertainty right now. It's bleeding into every single major sector. And tech is getting hit the hardest of all the sectors. And there is somewhat of a narrative problem emerging where it's not just about, I mean, you do have to factor in rates, you do have to factor in consumer spending, but I do believe there is a fundamental reset that's happening on how the market is valuing tech going forward. It's anticipating the consumer spending impact, or it's anticipating the tariffs potentially getting worse. Like everyone is just going conservative, not sticking their neck out. And what Sam was saying on the conference calls, there's not seeing that much of a recovery right now. It's actually quite the opposite. And it's just a tough environment to be in when you have this macro headwind and you have the technicals breaking down like as aggressive as it is right now. Like after 2 straight years of just way overblown performance, like why risk the biscuit? Like QQQ nearly doubled in like 2 years. Like that's wild to me. So I'm barely adding to any names right now. Like I have a 10% cash position. I think we're oversold. There's some names that I'm like, dang, this looks appealing to me. I'm just not being aggressive. Like I'm being very defensive. And I think we haven't capitulated yet. That's the bigger issue. Bottoms occur when there's just so much fear and everyone actually thinks the world is over. The market's never going to recover. We haven't gone that yet. I don't know. I know you're long about this logical stuff, so I'm curious on, are you just like chilling? Like what happens if we have like, because I think there's a world, which is what's scaring me, that SPY hits 500 this year. I do think there's a world where that can occur. So if that does occur, what would your scenario be like? Are you going to start just, you're max long right now. Are you just going to cut the bottom half your portfolio and reinvest in the top half? Like what would your strategy be if things get capitulatory?
Yeah, here's a good thought that I want to add in here is we're selling off on a growth scare, right? Potentially going into a recession, that kind of thing. So I think what people really miss, and I learned this from a Ken Fisher book. I love finance books. But one thing is stocks are the leading indicator. They're the leading economic indicator. So people always look at like, oh, look at job openings, look at this. No, those are in the past. Stocks tell you where the economic data is going to go. So the market sniffs things out ahead of time. So right now, all these stocks are getting absolutely crushed. And the time we're going to bottom, you'll know we bottomed because it'll come on some sort of economic data report like jobs data, and it's horrible. I mean, it's going to tell you that we went up from 4% to 6% unemployment. Oh my goodness, the world is ending. And then all of a sudden stocks are up 5%. And it's like, what happened there? And that's exactly how we bottomed in October 2022. We had an extremely hot inflation report, and people were so bearish. They're like, how could it possibly be the market bottom? And it's like, well, because it was worse than expected. We had already priced in so much. How much worse could it get if we feel that things are going to start getting better from here? So I would just say that stocks are getting ahead of what's going to happen. And the question is, we don't really know how bad this is going to get.
I also think that a lot of times when that occurs, they overshoot. That's another thing.
Yeah,
and that's why we bounce so hard, is because it's not as bad as anticipated. And like I said, the fiscal deficit spending is still not falling off a cliff like we thought it would. And so without that really falling, what's really going to be the state of the consumer? I understand everyone's going to be cautious. And something that you really need to think about when people are whispering about the R word, recession, right? The problem with that is that
I did not think you were going to go there.
Yeah. The problem is that
how dare you say the R word?
Dude, it is a self-fulfilling prophecy, because when people think that we're going into a recession or that we're in one, they start spending less. And then companies, because they believe that we're going into one, they start being more prudent and they start cutting back marketing spend, which is then that affects other parts of the economy. And that's why we see peak ad cycles. And that's what I was talking about earlier. It's a self-fulfilling prophecy. But you asked me about my portfolio and what am I going to do if we pull back? And, here's my thought. I told you I'm going into biotechs. if the real risk in this economy is the growth scare, like we were mentioning, then what's going to happen? We're going to see interest rates come down, right? I wouldn't see interest rates going up in the sense when we're slowing down as an economy. We already know that inflation is headed down in the right direction. We're starting to see that already month over month. We can hopefully see a sign there. And it's hard to see inflation pick back up with a weakening consumer, weakening economy, unless tariffs or something. But I think that's all noise at this point. So I think I think interest rates would come down. I think on the back of consumer potentially weakening, that's the real risk here. And so that's why I've been digging so much deeper and overweighting something like biotech, which is not at the whims of the US consumer. They have no sales going to consumers. It has nothing to do with that. Like if even Arcutis Biotherapeutics, sure, they're not in clinical stage or whatever. They're actually selling to consumers, but dude, if you need medicine, you're going to buy it. So healthcare, I think, is a pretty safe place to be in a slowdown. And these are really, really cheap valuations. And you got to think about one more leg in this biotech thesis is that the reason why they've been left for dead and nobody saved these assets and they're getting so cheap and they're in the most brutal bear market for the last 4 years is because typically you get a lot of spending from biopharmas. And you haven't really seen that because these guys, these CFOs can just kind of chill out and park their $10 billion of cash in the bank at, the getting a 5% on a T-bill with no risk. Why go out on a limb and, go do acquisitions, go spend on growth when you can just get 5% on that money and make a lot of cash returns for your shareholders? But now we're at a point where, hey, that interest rate might come down. You can't just sit on your butt anymore and you have a lot of cash to allocate and these assets are extremely cheap. If AbbVie wants to come out and, fill up their pipeline because they might have some sort of patent cliffs, they're going to have to be pretty quick on this while the assets are cheap. Otherwise, their competitors can start snapping these things up. And if these things start running, they're not going to get a discount anymore. So I think there's a deep discount there. You're not exposed to the US consumer. The interest rates are coming down. There's patent cliffs. They need to fill up their pipelines. I think there's a lot going on there. So that's why. Sorry, go on.
No. Can I ask you something? So let's just, because I think if SPY hits 500, for example, another 10% correction, I do believe there's going to be generational buying opportunities in specific names.
Yes.
I think a lot of your thesis for biotech, if not just yours in general, it's bumps. It's not generational because they will get acquired most likely by a bigger fish. If Amazon hits 150, if Palantir hits $35, $40, if Snowflake hits 120 again, Rocket Lab $8, are you going to maybe
swap over?
Explore exactly when you see those generational opportunities.
For sure. I mean, I'm making best allocation decisions based on the prices that are here in the market today, right? I have to make what's going on today. If Amazon gets closer to 120 or something,
120 would be wild. Oh my! I think 150 might be the lowest.
Well,
120, that'd be insane.
Guys, we're at 190, okay? And something to consider here is two things. One, if we get a true consumer slowdown, okay, their retail business
that wouldn't affect. First, I think we went over this a couple episodes. I think the retail business you're buying for free right now because AWS is valued.
Famous last words, but
no, it's true. AWS is making so much money. There's no way. It's that alone is. Let me pull the stat.
Look, last time we said 40, 50 times earnings for that, but that is also in bull market valuations. Just like in the bull market where we overshoot to the overvaluation side, in bear markets we undershoot to the downside.
First of all,
so all I'm saying is, I'm just saying never say never. One, I'm not saying I wouldn't be interested in Amazon at 150, but I'm just saying it would need to be really enticing because to me, what I see in biotech land, these assets are trading at Amazon at 80. That's what I would say. So it would really have to be appealing because where we are right now for this big tech is, yes, they're cheap, but are their forward earnings reliable? Are we going to have some sort of consumer slowdown, which is going to affect them? Are their ad budgets going to get taken away because there is a consumer slowdown? Look, I'm just saying, we're all speculating here. I'm just saying, how far can this bear market go? And that's going to depend on how slow the economy is going to be. And that's going to determine how undervalued Amazon might become.
So
I do want Sam to say, I'm going to pass to Sam in literally 10 seconds.
Go.
I do think that the way you're describing your strategy is a high floor stocks. By biotech will have a high floor because at the end of the day, they're trading cash value. They will get acquired. Where the names that I just mentioned, like that's not, it's like not a high floor. It's a very high ceiling. But go on, Sam.
Shai, don't forget, man, in the current market state and current fundamentals of financials for Amazon, 120 seems very unreasonably cheap for Amazon. But we are not in the land where Amazon could trade at 120. We're in the land where Amazon's going to be at 190. If this continues and we get into recession, but it's prolonged, like 2 or 3 quarters, Amazon could have serious compressed margins. Its e-commerce segment could be falling off a cliff, and then you'll get a contraction in AWS over time. If that happens, Amazon will be at 120. It will be. And I know a lot of people be like, I'm going to sell my house if Amazon goes to 20. If that happens at 120, dude, we're going to be in a recession, and you don't want to sell your freaking house in a recession. You're going to be poor. You're going to be selling your house to buy food if that happens. I'm not saying that Amazon will be at 120. I'm just saying, like, never say never. Because people said never in 2021, and look what happened. Amazon was at $80. Handed, they were in a major CapEx cycle building logistics systems. They were losing cash. I mean, not to the degree that they were about 15 years ago, but it can happen. Today, on the recent quarter, probably not going to happen. But if they post another quarter and another quarter market contraction, they could be at 120, dude.
I will go on record. I don't think that'll ever happen because of the CAGR of the AI market.
Ever?
No, the AI market CAGR is like 30% for the next decade. That alone is going to rise the AI workloads on AWS. Very minimal consumer exposure, AWS. Very minimal. They already have 40% operating margins. Like that's
dude. But
you have to
who
understand
rents compute from Amazon, from AWS?
Exactly.
Businesses. And if businesses stop spending money, that is going to be a downward spiral effect toward the consumer. And if consumers stop spending money, the business won't be able to make money.
This will change.
It's
going to be
okay.
No, it's going to be all AI agents. That's the thing. It's just going to be AI agents.
Either
We're going to have so.
I'm just saying, I'm being completely realistic, okay? Completely realistic. I believe in the AI wave. I think that we are in a major industrial and innovation at scale that we probably have not even imagined next 10 years, right? At the same time, if we get into a war, Microsoft's not going to be blasting this much money, okay? The people are not going to be buying cloud compute. They're going to get very defensive. Maybe not tomorrow, maybe not after a month, but like it can get bad.
So hear me out on this.
Go ahead, Trey.
You guys can admit 2008 was a pretty freaking horrible time for a recession. That was probably the worst recession you could have had, right?
Of course.
Their margins expanded from 2006 to 2008 to 2009.
Oh, come on, are you using Amazon in 2008 when nobody even like used the internet? Like
no, but
my first package was 2012 from Amazon.
Maybe, but they were a massive company back then, though.
I mean,
they were still a massive company.
Okay,
I'm just saying.
Were they not a massive company in 2021? Massive, right? They went down 55%, 56.
They're actually trading around where they were in the beginning of 2021.
So I think 2021 was an actual black swan where everything was at free money, 0% interest rate. That's just never been the case. Essentially, valuation multiples just expanded at such a stupid rate that I don't think that ever will happen.
Dude,
but
do you know Japan? Japan went through a vicious stagflation, deflationary cycle for 25 years, 30 years. And I'm not saying we're Japan.
Little cousin of economy of Japan.
I'm not saying we're Japan, and that's probably not going to happen considering we're the superpower of the entire world. But you can't discount these things happening, man. Look, like you can't discount where inflows go.
I just want to say this. Look, I'm not saying Amazon goes to 120. I'm not saying that. I actually think that we're probably getting closer to a bottom. And at 190, like we're probably getting somewhere closer to a bottom because I don't think that we're going to be in a vicious bear market. But again, these are still high beta stocks end of the day. So if S&P, which is a much more well-diversified asset than just owning a straight up Amazon, is down 20%, which would constitute a bear market, what?
No, I was going to say, okay, I shouldn't say never because if China invades Taiwan, we're all screwed.
Well, no,
okay.
That
put on my helmet. I know whose house I'm going to.
Look, I'm just saying this. 2021, not that different because you're talking about they had massive capex to build out their warehouses from all that retail capex. Like they pulled forward their retail business, all that growth capex. dude, they're gonna do like what 100 billion in AI capex over the next year. So we know their free cash flow is gonna get screwed. And what Sam was saying earlier was, if you get a recession, and again, my base case is not a recession, so I don't think it's gonna get this bad. 120 was the number I threw out there. Okay.
No, we're pitting you to that forever.
160
That's gonna be
makes a lot of sense. I think 160 makes a lot of sense. Like that would be a 33% pullback. And
I could see that.
It was,
Okay.
it was
market
just
is
there
down-
a few months ago.
Exactly. And if the market is down 20%, I think Amazon being down 33% is not that crazy. And they're in a capex cycle, so we know their free cash flow is screwed. If we got a real slowing down economy, then you know that their margins are going to compress on the retail side. Their margins are deeply going to compress overall because their ads business is going to be suffering. And potentially AI workloads do slow down for a quarter or two at least. So it's not crazy to believe that the stock can front run that. And if we get to 160, yeah, I'd probably be very interested in getting back into Amazon. And then maybe I'll think about where we're at with my other holdings and can I somehow get back into this and blah, blah, blah. But yeah, I mean, it just depends on where the prices are. I'm not really that interested at 190. I'll tell you that right now. I'm not.
Really?
Oh
my God.
If Amazon gets to 160, dude, I don't think you're going to buy Amazon. I don't think
I
you're
will.
Amazon.
I mean, I'll
because
start.
there's going to be so many other
That's a good point.
things on
'cause
sale.
true.
I gotta be honest.
That's a
Amazon
good point.
160. My Amazon position's big. I'm not looking to make it any bigger. I know there's going to be way more deals out there than Amazon at 160.
That's very true.
Way more deals. So I have to admit, if Amazon gets 160, I'm probably not going to buy. But I'm going to buy other stuff. That's for sure. But it really
Okay.
depends. I mean, if we got Taiwan being invaded by China, then I don't think we got to worry about stocks, guys. I think we got other things to worry about besides that.
Look, let's switch the topic. You
Yeah,
guys had the
yeah.
rubric report. I'll let you two take that on because you know the company a lot better than me. Go for it.
Before we get into that, do we want to get into
Yeah,
the...
yeah, let's do that. So before we get into rubric, I want to tell you about our sponsor. I want to give a shout out to ValueSense. The landscape of investment research is undergoing a massive shift. Sentiment tracking, automated valuation models, and real-time fundamental analysis are no longer the domain of hedge funds alone. ValueSense is breaking down these walls, ensuring that sophisticated, data-driven strategies are no longer monopolized by the financial elite. If you are interested in getting a leg up on the competition, check out ValueSense at valuesense.io. All right, boys, take it away.
All right, so Rubric is up about 20% after hours. And I don't want to get too micro in terms of Rubric's financials, but here's the thing of Rubric, all right? People think cybersecurity, it's another CrowdStrike, it's another SentinelOne, it's another Microsoft, Palo Alto, whatever. It's not. Nothing like that. Cybersecurity is a very wide space, and you probably know this, Shai. CrowdStrike, SentinelOne, Microsoft Defender, those are all endpoint detection and response platforms, XDR, extended detection response. Rubric is a data security platform that manages and scans all of your backups to bring your systems up in case you have ransomware. Could be a matter of minutes. I'm not going to sit here and advertise it, but as my big proponent about this is management and the people on the director board, they have the former chairman of Microsoft on its board. Even most of its management staff used to work for Oracle. Like, these guys know what they're doing in terms of software. And in fact, on top of that, they really don't have that much competition. Yes, there is competition out there when it comes to data security and backups, but most of that competition is like legacy solutions that are just now getting into this cloud backup game. Okay, we got Commvault. I can't think of other ones on the back of my head, but I think Acronis has one as well. But like these are legacy. It's basically like the Fortinet versus Palo Alto. Okay, or it's like Trend Micro versus CrowdStrike. Rubric is the CrowdStrike of data security. The best place to be, the best of breed, hands down. And they're very early in the game, growing at almost 50% year-over-year revenue, 54% subscription revenue, ARR grew 40% plus. Now this is the caveat with a lot of people when it comes to Rubric, is that they're still burning cash. They're not free cash flow positive on an annual basis, but they're expecting to get that next year. And on top of that, they do have a Microsoft backing. Major Microsoft has a big stake in them. So, I do expect this company to go places. Might not be for a lot of people because of the fact they're burning cash, but I'm wondering, I think, Shai, you and I are very bullish on cybersecurity, but what are your thoughts on Rubric?
First off, cybersecurity is probably I don't want to say safest, but it's somewhat of a safe haven among one of the emerging growth thematics in the agentic AI world, where it's going to be the stickiest component of any IT budget. They're not going to go for the second and third tier cybersecurity names to save a couple bucks. SentinelOne.
I knew it.
So they invest up in like the best of breed, like the CrowdStrikes out there. But yeah, you said it really well. I think rubric really isn't. Cybersecurity has always been a game of like the who has the greatest barrier of entry, who has the greatest moats, and these not moats, the greatest barriers of entry for protection because they keep a lot of the attackers out. It's like a lot of these sophisticated AI-driven attacks really haven't come to light yet. They will. Trust me, in the next couple of years. So I think a lot of these endpoint protections, like the CrowdStrikes, SentinelOnes, like they do neutralize the threats before they actually breach the critical systems. However, sometimes they breach. Breaches happen. They always happen. And July 19th outage wasn't really a breach, just self-inflicted, but you kind of saw the implications of what a breach can occur in cybersecurity. So the better question is whether or not the attackers will get in. It's how quickly can the business get back on its feet when they do. So that's the biggest difference on what Rubrik can offer. Like they're not playing the same game as a traditional security firm. They are the PB&J to CrowdStrike in the cybersecurity game. They aren't in this endless arms race of detection prevention. Like they're just trying to render their efforts towards just being futile. Like they're just trying to make sure everyone gets back in their feet. It's not just it really isn't just an added layer of defense. It's a completely different paradigm. We're in a world where cybersecurity attacks are going to continue happening. This is the way to recover your data as quickly as possible because it's a necessity in this future data-driven world. And when Sam mentions like, let's not get micro on the numbers, well, it's a good thing because it's pretty ugly, the micro. And that's what's probably preventing me. Like that's the only reason where by ugly, I mean, they aren't going to be profitable until 2028. Don't love that. They did produce
GAAP profitable, not free cash.
GAAP profitable, sorry. But like a lot of the cybersecurity firms out there are GAAP profitable now. Like look at CrowdStrike. Like at their rates are growing with their margins are GAAP profitable. So like there is somewhat of an expectation, to be honest, that in this cybersecurity space, it's not like the software space with consumption models. They need to be somewhat GAAP profitable. That won't happen for a couple of years, but they are free cash flow positive. So that's a big thing. They did just cross $1 billion in subscription ARR, growing at 38% year over year, sir. Like that's massive. And their big time customers, like the customers who are making over 100K, I think went up 32 or 34%. And their net revenue retention is above 120%. Like they're showing really strong numbers and they have 7% free cash flow margins they produced this recent cycle. And they're guided up significantly. Like their Q1 guide, I think, was supposed to be around 242. And I think they came in at 260. So it was like a 10% beat on their Q1 guide. Like this is a company that's just growing substantially. And I think if your thesis, which again, part of my thesis is data is going to freaking explode due to AI agents. This is one of those thematics or TAMs that are going to be growing at a rapid pace because of that. And cybersecurity is going to be an essential component of it. This is probably a top 3 name on my watch list. I was hoping that they messed up. Not messed up. I was hoping this macro environment would punish a great results just because, I don't know, they missed on some weird profitable metric. But no, it was a clean beat across the board. And I'm not going to get that opportunity to add at $45 or $40. Like I would love to add this name under $40, to be honest. And this is one of those names where if Amazon hits 150, 160, I think Rubrik will be below 40.
Sold off. Yeah.
And that's probably better alpha, to be honest, than in Amazon. Like Amazon right now, I'm treating Amazon as my number one position. Sam, it's your number one position. I don't know if it's logical anymore. It's not, because he just said he wouldn't touch under $200. It's kind of my anchor stock. Worst case, like I have a 10% cash position, but I have a 12% Amazon position because if SPY hits 500, like I don't want my portfolio going down 30-40%.
Yeah, that would suck. That would suck.
I don't think Amazon, worst case, Amazon goes down 20%, I think. But yeah, I don't know. I think if you don't have cybersecurity exposure in your growth portfolio, you will be really upset with yourself in a couple of years. Like it's just one of those themes that you need exposure. And like CrowdStrike's the tier 1 play, to be honest. Like they're recovering the outage. Second half this year, they're going to see reacceleration. Next year, it's going to be even more reacceleration. Like the outage is behind them. And they just had a massive gut punch to test their moat. And they proved victorious, to be honest. They 97% churn, that's it. After that kind of outage, that's like insane. Also, I don't know. They have to acquire their growth. Like they haven't improved any organic growth for years. I think they're just riding on their blue chip customers, and they're just not caring innovating as much. I don't know, Sam. You might have a take on that.
Well, I mean, Pelosi don't miss, dude. So she owns Palo Alto.
They have great government. That's a good point. Does Doge affect those government deals for Palo Alto?
Well, I mean, that's supposed to be the case for ServiceNow. So ServiceNow has actually gotten to a better valuation. It's certainly not cheap. It's like around 11. I think it's back to 11 times EV/NTM revenue. But Pelosi's betting on Palo Alto. In fact, when they had their earnings where they started talking about platformization and the stock sold off like 30%, I went in hard on Palo Alto. And the very next day, they disclosed that Pelosi bought call options at Palo Alto. And I was like, Pelosi, thank you so much. That stock ripped that day. And then I got out of swing positions. But see, all this, like, this is all fun and games in 2023 and 2024. Like, I would not do that today. Like, this is not the environment where I want to be, like, calling the bottoms on certain stocks get sold off like 30%. Because if I did, I would have call options on TTD, which I don't. You know,
Let's talk TTD a little, actually.
Wow, dude, you're going to get into this?
I kind of want to talk about that.
Well, first of all, it's just going to be like 10 minutes of logicals telling us that that the ad cycle peaked like 2 months ago. And we're going to listen to it.
I won't butt in.
Yeah.
I won't butt in. You guys go for it.
Well, TTD is just falling off a cliff. If you think the market fell off a cliff, TTD is nearly 50%, more than 50% down. Actually, I think it's like 60% down from its recent all-time highs, not more than 2 months ago.
It's down 54% in 2025.
Is it 50? Oh, yeah, 25. So they're already going down before that because they hit like an all-time high, like around 130 or something. Now they're at 53. Right? Am I right?
Yeah, and they're trading at 30 times earnings now.
53. This is for a 17 to 19% growing company. The leader in demand-side platform for ad tech, not a walled garden, but the most pure play advertising demand-side platform you could possibly think of in the market. They changed the game in advertising with their proprietary software. Now, we've talked about this on length's end, but I think kind of relating this to the existing topic in terms of like just seeing companies getting like slaughtered, you know, and I'm not saying that it wasn't for a reason. Like obviously TTD had a pretty bad quarter. You know, if you believe in management, then you'll stick to the game. But at the same time, it's like, dude, it's not like it's slowly bleeding. It is relentlessly getting sold off. Okay, so like, I'm below my cost basis on it. I'm not gonna lie. I am below my cost basis at TTD.
Oh my god,
and
so am I. Mine's
very
like
green
$60.
on it. I was like mid 60s, man. I'm getting slaughtered on TTD, but I'm not really buying a lot because the position was already built to begin with. So like, I nibbled maybe a couple of shares or something in the last couple of weeks, but like I am not aggressively buying a falling knife like this. Like the market's a falling knife, but like when it comes to buying in this type of downturn, the last thing I want to do is to deplete my money in one day. Because if I did do that, I would have depleted my money like weeks ago. I'm taking it easy on this, man. I'm buying slowly and working the dollar cost averaging while having some cash on the side in case we do get that massive flush that's going to flush everyone out and then rip right back up after that, most likely. Like, I still have cash on the side waiting for that to happen because it's going to happen. And when it does happen, I want to be ready for it.
So I think this is a really good topic because I haven't had this much of a back and forth mentally about a position, long-term position, in a long time. These kind of pullbacks, QQQ going down 13%, you're not supposed to be adding to the laggers or the ones falling knife. Like you're supposed to be buying the winners that had no thesis cracking in their earnings, back-to-back earnings. Like they're pulling back just because the market's pulling back. That's why I'm adding to Axon, Cloudflare, Amazon, etc. Like those are where my soldiers are going towards. But TTD, I'm just looking at it now. 30 times earnings. It's one of the cheaper valuations the past decade. I know PubMatic, we're talking PubMatic, Magnite. they're trading at 15 or 16 times earnings. Now TTD is only 2 times the multiple of those names with a substantially different margin profile. Substantially different. So that's part A. Part B is I just think I have a 10% cash position. Though I've been researching TTD a lot this week because I have a 2% position in this name now. If I want this in my portfolio, I should just either cut it or actually do the research and see what actually happened in the previous earnings cycle, because it was such a one-off that only happened once every 33 quarters. Like, I need to see if it was due to the demand or is an internal issue or whatever it might be. And if I think it's going to be a bump, like, why not double my position at this valuation when I have 10% cash position already? And it's a 2% position only as a $30 billion market cap. So I do think, like, I feel bad for myself. I don't feel bad. It's just like, I've been so back and forth talking about like the frustration of the stock that I just don't really know if I should buy it, reconsider it. I do think when one of the major issues for TTD was, I called out like after the earnings that why are their margins not, why is there no margin leverage anymore this previous cycle when you saw the other names, the Metas, the Googles, the YouTubes out there like show like margin expansion that match up their growth growing. Like, it felt weird that TTD had a massive issue. Then the more I researched, it looked like obviously it wasn't a result of an industry-wide ad spend, because I just called out those bigger players showed really strong numbers. So it wasn't an ad spend weakness. It wasn't a macro-driven slowdown in the past 3 months. It really feels like you heard Jeff talk about in the conference call. It was an internal issue that he just would not communicate openly. And that was causing more fuel to the fire of like, what the hell happened? And I think it really was like, the more I researched it this week, I think people hated. Is it Kokai? Kokai? What? How do you pronounce it? Kokai?
I mean, I'll tell
the
you.
rollout.
Yeah, I'll tell you. Oh, go ahead.
No, I was gonna say how do you pronounce it first before I
don't know how to pronounce it. Yeah,
it's Kokai. Kokai.
Yeah.
Kokai. I just say that. I'm blanking on it. But that's a new major rollout that they want all their clients to kind of adopt. There's been clearly hesitation. Jeff said something about like his internal circle butchered that rollout, and it disrupted a ton of the organizational changes at the wrong time and introduced like a lot of uncertainty on like this new rollout having the demand. The user face is apparently hideous. The UI is not appealing to all of the agencies. So like, this came out of nowhere because TTD always, they're very conscious on their clients and like what they need, especially in every new rollout. And they told all the agencies they want them to use this new major rollout by the end of this year or sometime this year. And I'm like, why would you butcher it as bad as it is then without having like consulting the agencies what they think? Like, they typically do that. So I think right now, like, that internal fumble is what Jeff was talking about. And I think that he is hiring a new COO. I think he is like doing a lot of like the VP shuffling because someone butchered it. And that happened before all the consumer recession talk. Yeah. So that was an internal issue that caused a 40% reduction in price. Add that any stock with consumer exposure, especially ad tech, because that's the first cut in any discretionary budget once a consumer recession occurs, that added fuel to the fire of an additional sell-off. So now all of a sudden we have a 60% pullback in a name that doesn't pull back that much. It's rare. So I'm like, I think Jeff's riding the ship. Like, the more I'm reading, like hearing him talk about this, I've been listening to the conference call again, his interviews, like, I think he knows what occurred. He just doesn't want to throw his like soldiers under the bus, but he's making the adjustments needed. And I think, like you said, this product speaks for itself. It's like, yeah, I'm going to bet that this gets re-rated to 45 times earnings. And if that does happen, this stock is a $70 stock again. It's like, maybe I double my position and make it a 4% position again. And I still have an 8% cash slot, which I'm totally happy with. Like, that's what I'm going back and forth with. What do you think about that, Sam?
So I'll tell you something that wasn't really said in the call, but I kind of know this from my own experience, because you're talking about, change of heads of the COO, looking for a new COO or whatever. I mean, they don't really have one right now, but okay. So the COO is a chief operating officer, right? Usually the IT department falls under a COO, usually for good companies, right? Sometimes it falls under the CFO, and that's when it's going to be disastrous for an IT company. That's in my experience. If you take TTD, for example, Jeff made it a point in the call to say that they're switching over to an agile methodology, which is basically a word, you probably already know what this is. It's the way to manage projects and manage tasks for especially engineers in a company. Without an agile methodology, you're mostly doing waterfall, or you're mostly doing some sort of iterative method for deploying new products and releases for your clients, right? If you're switching your entire methodology for project management and announcing it on an earning call, there is definitely something going on underneath the hood, and definitely big transitions happening, which kind of makes sense. They have no COO. My guess is that's probably the reason why the CEO got kicked or resigned, whatever it was. I actually didn't really look into that much. Now you mentioned, I should probably look into it more, but that is a transition with the company, because now you're changing how you're rolling out new updates and products for your clients. And now you're changing the cadence for your clients that they have to adjust to the new clients that are being released, because, you got security to worry about, you got to test it and everything, whatever. It's not just something like, here you guys go, like a CrowdStrike, whatever. It's a bit different for this aspect, but at the same time, it's not as critical. The thing is that having no COO in a company, and like you're saying that Jeff Green is probably riding the ship right now, wearing two hats or more than two hats, which is probably he was already doing, it's very hard to operate. That's going to take away your focus from running the entire ship. Now you're wearing two hats, and now you're worrying about other reports that are reporting directly to you that haven't in the past, and now they're unsure what's happening. And you usually, and you probably already know this, when you get rid of an executive officer, 2, 3, even 4, maybe the entire department completely changes roles after that.
Well, that's why it's so important to have a founder-led CEO, because he'll live and die on that company, and he's willing to work 80 hours a week to wear those multiple hats.
Yeah. So
continue your thought. Finish your thought. I just want to add. I mean,
that was really it. Like when they said that, he kept on mentioning. I'm just like, why is he talking about Agile on a conference call?
It was weird. That's what I'm saying.
It was like,
someone
why is he
messed up really
talking
bad
about that? Like, that's such a weird thing to talk about on a financial conference call. Like, why are you talking? Man, I don't know what's going on in there. And if I worked at TTD, I'd be afraid for my job, or I probably wouldn't have a job anymore because I probably would have already been laid off. But at the same time, it's like, kind of got to know when you got to read between the sentences, read between the lines here. Like, this company is not doing good right now. It's not going to bounce back tomorrow or next week, and not with the market falling down like this. It's going to take a little bit of time to recover, and got to be okay with that. Like, when I bought those shares right after the earnings, it wasn't a lot, but when I bought them, I was like, I think I made a mistake. And clearly I made a mistake. It's like almost 50% down from where I bought those shares after hours. But I mean, gotta ride it out. I definitely am sticking with the thesis here, but I don't. Oh, go ahead.
No, I was gonna say it's tricky because like I feel wishy-washy. So after that earnings report, I sold some of my position. Like, I sold, I think it was 100 shares. I went from 300 to 200. Now, weeks later, I think I might double my position. It's going against my ethos of what I'm going to do in this pullback. But like the more I'm reading about it, it's relieving that it feels like it's not a demand issue. It's just an internal F up. And those are, it takes some time to flush out, like 6 months, most likely, to be honest. But when it does turn around, it's much quicker than trying to get demand back into your product and ecosystem. Agencies are very quick to forgive in marketing. They just are. All they care about is ROI.
It just feels like it's the perfect storm though, right? Because they're having issues on their end, but then also you do potentially have demand issues coming. Potentially. Because it's not really them.
It's like MongoDB, dude.
That's what
it's basically MongoDB as well.
What were you gonna say?
No, I was gonna say that perfect storm you're describing, that's the only scenario that will cause TTD to go from 130 to 50.
But yeah,
in like 3 months.
Yeah, so I mean, then you got to really ask yourself, like, is this? I mean, the thing is, like, all the ad names are down, so it's tough, and that's why I was saying. Remember, we were talking last time, and I said you're like, that's why you have to own the best, and I'm like, dude, it's not gonna matter because if we're in a true peak ad cycle, it's over.
Do not throw those words back at me. I did not anticipate an F up of that. Like, that was crazy. That's like amateur startup style.
Between that time and this time, I've started the position and added pretty heavy to App 11 in the low 200s.
But I mean, look, I just want you guys to understand.
Yeah.
I just want you to understand that if like these stocks are not going to recover until the entire market recovers on like the back of no more consumer weakness, and actually the ad market is fine and everything is good.
No, it didn't.
You guys should pay attention to short interest ticking up. If it's getting worse at the lows, that's something
that would be crazy. Are you tracking? How do you see that right now?
FinViz.
Let me see.
FinViz is pretty late though.
Oh, it is?
Like it's not going to show you up to date. It's going to be like 2 weeks old. So depending on
Shoot,
what day
that'll
you
be
check.
bad. Okay, we'll talk about that after because we're nearing the
Yeah.
top of the hour over here.
I mean, yeah, I even thought like, look, I know you always like say you want to own the best and not a Magnite, but I thought from like a small cap perspective that's landing Netflix deal, which is big volumes, which is landing the DirecTV live sports deal, X partnership. You know, there's still the Google ad tech antitrust, which could lift all of these open internet players. I thought that would even be a little bit more resilient, but I told you last time I cut 90% of my position, 95% of my position, and like, I mean, I'm just not gonna. I'm gonna wait to see how this turns out and turns around, and I'm happy to just buy it on the way up if we just turn around because you know, let's say it's at Magnet's at $12. It was at 21.
Yeah,
recently. That's insane on a good report. On a good report, which tells me that there's something else happening in this market, which is people are potentially forecasting that marketing budgets get cut back because that was a good report and they have a lot of tailwinds for this year. Benchmark came out and said, no, we still reiterate our $25 price target. That's a double from here. So I'm just going to wait to see where the dust settles. And like, if I, miss it at 12, but I buy it at 15 and it goes to 25, I'll be fine.
This is the important thing to realize, though. We mentioned this early on the call. Folks overshot what they expect to happen.
Yes.
Let's just say not worst case, just say like there really isn't a consumer recession fear. We're just speaking that narrative into existence. Holy moly, these ad tech names will be the best Q2, Q3 players.
Totally. I will be full on like at these prices, I'd probably make like Magnite a 15.
So what would your signal be to make you believe that this is just FUD? It's actually not going to be a reality.
I don't know. I'd have to see price action, their next earnings report, which we should start getting stuff in a month, right? And start getting some of these things rolling in. We'll start seeing how ad guidances are going. And if, I think.
Do you track monthly retail sales? Like, is that a good indicator on like?
I'm not that smart. I would just look at like how did Google fare? Because they're typically the first to report from the ad names and just see like, are they growing? If they are, budgets are probably still okay. Though obviously Google is going to be more resilient than the open internet players. I don't know. I'll just have to see the price action too. Like I want to see these things like reclaim certain. Like I'm okay buying after the big spike on big volume and whatever. Like I need to see something. I just need some sort of confirmation. But right now it's just lower lows and you're just.
Well, I'll tell you something, dude. Sentiment's going to flip fast if we bounce. Yes, it's going to flip very fast.
My base case is not a recession.
It's pretty.
It's
a daily. First off, TTD has a daily RSI of 20 on their weekly chart.
Yep.
It's going to bounce. It's going to have some kind of massive 5 to 10% week probably. We'll see where it goes from there. I'm looking to see where the anchored average VWAP is from IPO because that's a really important one. That's my favorite metric. Wow, it's got ways to go. 30. I mean, to be honest, if it hit $36, which it could, absolutely could.
That'd be insane.
If they disappoint their next No, but if they have a similar earnings report next cycle, that's like, wow, they got it down again. I do think it goes to the mid 30s.
Yeah, no, when I say that's insane, I don't mean like it's not going to happen. We just had this conversation about Amazon. It's just like I would have never saw that coming, dude. Honestly, even here, I would have never saw this coming with TTD. Like when that thing was at 130,
it was at like 100 times EBITDA. I don't know, man.
No, it
got there. But it got their premium valuation removed. That's what happened in TTD.
100 times.
But it was deserved at the time. It was deserved at the time. Exactly. 33 straight quarters. 33 straight quarters of dominance. It was deserved.
100 times. I'm going to say it again. It's 100.
Was it 100 times?
Yes.
Yeah.
It was 80 times when I said it was overvalued, and then it went up like.
All right.
So Magnite's trading at 30 times EBIT. Let's see what TTD is right now.
Nah, it's looking pretty interesting. I'm not going to lie. I don't know if I'm going to buy right now because other stuff, but
55 times EBIT.
Still public.
25 times EBITDA though. Trading at.
Yeah, I guess now maybe.
That's you have to admit. All right, let's just say like you just saw TTD for the first time. 25 times EBITDA, growing this year at 18% top line with 39% EBITDA margins.
Look, it just depends on.
That's really cheap.
Look. I would rather buy this company. Listen to me. This is gonna be crazy. Your mind's gonna be blown. Okay. I would rather buy this company at 100 times EBITDA. That sounds crazy, but not when we're at when we're approaching peak ad
because
cycle.
the
I'd rather
cyclical
have it
of
on
it.
depressed earnings. I'd pay 100 times EBITDA for that business, but when they have no earnings, which then I know is going to compress to like 30 times in the next year. That's what I would say at that point.
Yeah, I'm worried that maybe they'll never grow over 20% again. Like that is a worry, guys. If that does, if this is like a high teen growth story going forward, I don't think it belongs in my growth portfolio. I'm literally underwriting that I'm returning to 20% growth next year. Like
And that's
am.
that's the problem why I don't like large caps is the law of large numbers gets you sooner or later. No matter 30 quarters, whatever, some point you outgrow.
Not
and now it's like,
Palantir. Not Palantir.
you wait for it, buddy. It's coming. Okay. Any other thoughts, Sam?
No, man, that's it. I mean, we'll see what happens. Like, to be honest, I mean, this is how bad it's getting. I'm expecting the market to be down tomorrow. Like, this is just how bad it's getting, right? And I feel like I'm not the only one who's pretty much had like any type of bottom calling confidence, like shot to the chest. Like, it's fine if it goes down, but it's like, I just assuming it's going to go down tomorrow. And we've seen.
Well, how can you think otherwise though? It's lower highs and
exactly.
we finish a low of days all the time.
But what I'm saying is that this type of sentiment is what catches people off guard. So I'm prepared for that as well. Like I'm prepared for it to go up. I'm prepared for it to go down. Whatever happens, like at the same time, like not really using. I'm not a margin, but that's just how I work. Everyone's cool with margin. For me, it's like in this environment, I don't want to be a margin. At the same time, I mostly have shares in my portfolio, so it's cool. But yeah, how about next week? It looks like we have a couple of important earnings next week.
We have earnings still. Well, I will say when we look at the earnings calendar, the last 2 Fridays have been very green, followed up with very even bloodier Monday opens. So see if that trend continues tomorrow. But next week, open the earnings calendar for next week. Oh, we do have some. Let's see. I don't see
Healthcare names, the biotech spray, ARS Pharmaceuticals on Monday, it looks like. Or it's not, it's the 20th, sorry.
No, I don't see anything on Monday. We got
I have one on Monday, sorry. It's Sonida Healthcare. They're like, it's almost like a REIT-ish, but like they have like senior living care facilities. They grew their unit count by 30% in the last 6 months. Really smart people. Smart capital allocators at the helm. It trades at like a 10% cap rate. Very interesting. Also, PDD is on Monday as well.
Well, I see the 20th. Maybe you're probably right though, because sometimes Earnings Hub is kind of off with the. But Earnings Hub is usually pretty accurate. But the Chinese companies,
you're right.
it's not.
Sorry, I got my dates mixed up.
Okay.
You're right. It's on the 20th along with Spray ARS Pharmaceuticals.
Accenture is on Thursday morning. That's gonna be an interesting one.
the Legacy Consult. Yeah.
Yeah. Also, Micron's on Thursday afternoon. Lennar is Thursday afternoon as well. That's going to be interesting to see the housing data. Nike's on Thursday afternoon. So is FedEx. We've got a few China stocks, but honestly, earnings season is pretty much over. Well, at least for me now.
Shai, did you see any that you were wanting to look at or no?
No, it's all pretty much over in my opinion. We got China, like you said, PDD, NIO. We got KC. A lot of people don't know about KC, the cloud name of China. Wow, it's $17 now. That's kind of crazy. You got Tiger. Wow, it is China week next week. Jeez,
Yep.
Is it always like this every earnings cycle? They're always the last week of every earnings.
Yeah.
Guess we're now paying attention, huh?
There you go.
Ooh, we are. You're
Yeah,
right.
There you go. Market's paying attention now.
And let's see. After next week, we'll go over that next time.
I got 3 earnings next week, so that's more than I thought. So that's legit.
Yeah, I got none. Yeah, I mean, I think everyone is just watching for what's going to happen in the market. I think it's less about earnings. It's all about markets. And NVIDIA is showing strength. I'm curious on what NVIDIA is going to start doing from here because they have been the market leader so far the past 2 days. And that is a trend that's been like that the past 2 years. However, I'm not touching it until it clears 120. 120 is a massive level for them. So dead cap, I will say, I mean, guys, like look from the January 2024 anchored average VWAP. This has been the perfect metric to add to NVIDIA. Every time it's hit that, April 2024, I don't know what occurred then, but there was a massive pullback, bounce.
That was a whole market pullback for reflation narrative. Everything.
And then we had the yen carry trade crisis to the dot, bounce from there. Then last week, bounced perfectly off that level. This is the metric to use for NVIDIA. So if it clears 120, I do think I'm going to participate in the trade for NVIDIA. We'll see because I think these are the type of moments when you have to see like who's performing relatively well, because they're going to be the leaders of this bounce that we're going to have potentially in the market when it does. Axon's doing really well this like past week. We had honestly AppLovin's doing really well. Snowflake was only down 1% today.
Yeah.
That's surprising with SaaS being down like 5+%. NVIDIA was green. Like, look out for these names. Like, they're going to be the leader. Also, CrowdStrike before today, but CrowdStrike pulled back 3% only today. But the last 2 days, it was up 7% on no news. Like, that was interesting. So be cautious out there. Yeah, I know we're at the top of the hour. I'm going to give my 2 cents. I'll let you guys finish off as well. Awesome episode 9. I'm trying to think of an NBA player. It's called Iggy, the Iggy 9, Andre Iguodala. So this is the Iggy episode for us. Let's hope we learn a new hobby by the time we record next week. It's not going to be just losing more money. We're getting pretty experienced in that. But yeah, don't get greedy. Raise a cash position. I've been advising people, like, I have a healthy DCA. I put cash every week in my portfolio. If you have a fixed amount, go 15% cash. Like, I think you can't, or if you're not as experienced as like these folks over here, if you're passive, like, just go cash. Like, I think you guys need some cash position if things get worse. But yeah, don't get greedy.
Advice?
It's not financial advice.
You're giving, did you say 15% cash?
Yeah, I think so. I think things could get worse. I think SPY 500 is a reality if things in like sometime this year. I really do.
Net new funds or
no. I would sell your lower conviction names to raise that cash position. Yeah.
I mean,
you never know. It could go down more. You never know.
That's what makes a market, baby.
I will say right now, maybe not's the move. Like, wait for the next like little dead cat bounce that will clear the 200-day moving average.
Yeah, that's what I started with.
Yes, Sam, logical. You guys want to close it out?
I would just say to that, it's like too late to sell, too late to short. I'm waiting for a bounce before I could offload some stuff. And yeah, lower conviction, probably the best place to cut. Yeah, I mean, just know what you own, be able to fundamentally justify the companies that you own, know the valuations, know the free cash flow multiple of the growth, etc. And that's the only way you're going to be able to feel comfortable through volatility to hold something, is if you really feel comfortable with the business. That's what I'll say.
That's it for me, guys.